All right, welcome back to The Explainer. Today, we're putting on our detective hats because we are going to solve one of the biggest mysteries in commercial real estate. What happens when a budget that looks perfect on paper just completely falls apart in reality? So yeah, let's get right into it.
Look, it's a case that pretty much every asset manager has faced at some point. You've got this solid plan, right? A really well-researched budget, and your expectations are high. But then, the monthly numbers hit your desk, and you just know something is very, very wrong.
And that is the exact moment the investigation begins. I mean, that $450,000 gap, that's not just a number on a spreadsheet. No, that's a story. It's a story about unexpected events, missed targets, and maybe some hidden problems. So the real question is, how do you find out what happened? And, more importantly, how do you fix it?
To solve this kind of mystery, you're going to need a special tool. And no, it's not a spyglass or a fingerprint kit. It's actually a super powerful analytical method that lets you see every single detail of your property's performance.
This is it. This is the tool, variance analysis. Seriously, you should think of it as the financial forensics of real estate. It's how you systematically uncover all the clues by comparing what you planned to happen with what actually went down. It is an absolutely critical tool for any, let's call it property detective, who's trying to get the best possible performance.
And you know, at its core, the concept is really simple. On one side, you've got the budget, that's your plan, your blueprint for success. And on the other side, you have the actuals, the cold, hard reality on the ground. Your entire investigation, everything you're looking for, it lives right there, in the gap between those two columns.
Okay, so once you start digging into that gap, you're going to find all sorts of clues, or what we call variances. But listen, not all clues are created equal. The very first thing you have to do is sort them out into two different piles, the good ones and the bad ones. So here's how you tell them apart. A favorable variance, that's a good clue. It means you either made more money or you spent less money than you planned. Awesome. An unfavorable variance, well, that's a bad clue. It points to lower revenue or higher expenses. Both are totally essential for understanding the full story of your net operating income, or NOI, which is basically your property's profit before you deal with the mortgage and taxes.
So where do you usually find these clues? Well, they tend to hide in plain sight. On the revenue side, you're looking at things like rental income. Did a tenant leave early? Maybe. Or on the expense side, maybe a surprise HVAC failure just completely blew your repairs budget. Or maybe property taxes came in way higher than you projected. These are always the usual suspects. But here is a really important point. You can't chase down every single tiny clue. You'll go crazy. You have to prioritize based on materiality, which is just a fancy way of saying how big the clue is. A really small variance, say under 5%, you probably just need to keep an eye on it. But a variance over 10%? Whoa, that's a 5-alarm fire. That requires immediate action. This is how you focus your energy where it actually matters the most.
All right, so now we know what we're looking for and how to prioritize it. Let's talk procedure. A proper financial investigation, it follows a really clear 6-step process to make sure absolutely nothing gets missed.
Think of this as your investigative playbook. First, step 1, you gather the evidence. That means collecting all the key documents, your actuals, budgets, invoices, any notes from the property manager. Then, step 2, you find the clues by flagging any of those variances that are big enough to matter. Now, step 3 is critical. You have to find the motive. This is where you do a root cause analysis to understand why it happened. Was it a one-time surprise, like a hailstorm damaging the roof? Or is it a new concerning trend, like utility costs that just keep climbing? Once you know the why, you move to step 4, writing up a report for all the stakeholders. Then, step 5, you actually take corrective action. And finally, and this is so important, step 6, you reforecast. You use what you just learned to create a much more accurate map for the future.
So, we found the clues, we figured out the causes. But why does this all matter so much? Well, because these variances have real-world consequences that can ripple out and affect every single part of the investment.
And you know, this slide shows so clearly that context is everything. An unexpected vacancy means very different things for different properties. In a multifamily building, it's about the immediate cost of turning that unit over to get a new tenant in. But in retail, if a major tenant leaves, that could trigger something called co-tenancy clauses in other leases. And that means other tenants might get to pay less rent or even break their lease entirely. That's a huge cascade effect you have to get ahead of. And who's waiting for your report? Oh, just about everyone. The asset manager needs it to tweak their strategy. The owners need it to see if their investment is on track. And you better believe lenders are watching your debt service coverage ratio, your ability to pay the mortgage, like a hawk. Even the acquisitions team uses these reports to help them make smarter buys in the future.
So ultimately, this whole process isn't just about finding what went wrong. It's really about learning, adapting, and transforming a bunch of data into real decisions that both protect and create value.
So how do you get really good at this? How do you become a master detective? Well, you follow a few key rules. Number 1, start with a realistic budget, not some super optimistic fantasy. Always build in a contingency fund for surprises. Also, learn to separate what you can control from what you can't, so you can focus your energy. And finally, use rolling forecasts so you're always working with an up-to-date map, not some static plan from a year ago.
This quote really just says it all, doesn't it? The whole goal of variance analysis, it's not to create some report that's going to sit on a shelf. It's about turning a spreadsheet full of numbers into a strategic weapon. It's all about taking that raw data and forging it into actionable intelligence. So the next time you're looking at your financials, try not to just see numbers. See the plot. See the characters and the clues. Every single budget variance, whether it's big or small, is part of a much larger story. And the only question is, are you listening? What story are your properties trying to tell you?